Hey guys, welcome back to another video. My name is Josh, and in today's video we'll be taking a look at A2 Milk. On Friday afternoon, the company announced a massive revenue downgrade, and that sent the share price crashing all the way down to $11. So in today's video, I'll be performing an intrinsic value calculation, and I'll also share with you my thoughts on the whole situation. Hopefully you enjoyed this video. If you did, be sure to hit like and subscribe. I spent all of my Friday midnight working, updating my spreadsheet to get this video out as soon as possible. So I really appreciate the thumbs up for the YouTube algorithm and to get this video out there to people who you know will find this helpful. And as always, this is not financial advice, purely for entertainment and educational purposes only. I'm not a financial advisor. You can read the full disclaimer down below. So let's get right into the video. So as we can see here, A2 Milk is down to $11. Down 22.1%. In the past 6 months, the share price is down roughly 45.89%. I've explained on this channel what has caused the share price to drop earlier in the past few months, but today we'll just be looking at this 22% decrease, and we'll be taking a look at the guidance and updating the spreadsheet to see what the intrinsic value of the company is. So looking at the announcement, the company did provide an updated guidance to FY21 as group revenue for financial year 21 to be $1.4 billion to $1.55 billion, and group EBITDA margin for financial year 21 of between 26 to 29%. Okay, it also mentions that the board considers it appropriate that the company target an EBITDA margin in the order of 30% in the medium term. Okay, so this will be part of our intrinsic value calculation as well. And the reason for this revenue downgrade is because the impact on the Daigou channel was more severe than they initially expected. And so they are reducing their group revenue as a result of that. Let's now talk about the intrinsic value calculation that I performed. If you don't know what an intrinsic value calculation is, basically what I'm doing is I'm taking the future earnings of the business, I'm forecasting what they would be for the next 10 years, and then I'm discounting those numbers back into today's values. If you're getting $1 in the future, obviously you have to discount it by a percentage that you want to receive. Okay, so for example, I've used a discount rate in my model of roughly 10%. And the reason for that is I want a return higher than what I can get on index funds because I'm picking my individual stocks. So I'd rather have a higher rate of return than index funds, which historically have returned roughly 6 to 8%. So I'll show you guys the assumptions that I make now in my model. So here we are in my intrinsic value calculation. So what I did was I took the revenue guidance that management have given us and I put low as $1.4 billion and a midpoint of 1.475. That's basically taking the high point of 1.55 plus 1400 divided by 2 to get $1,475 million. For the EBITDA margin, I had the low point of 26%, that's based on management's guidance, high of 29%, and a midpoint of 27.5%. And so this is the bear case that I have. So this is the worst possible case that I think the company will do. And if we use the low point of management guidance, that is $1.4 billion. And the growth rate that I use for the first 5 years is 10%. Now, the reason why I use 10% is I think that's a fairly low growth rate based on what the company has historically done. So as we can see here, if we look at the revenue growth rate for A2 Milk, the company has grown revenue at quite a high rate in the past. So in FY17, it was 56%. 68% in FY18. In FY19, you can see it starts to drop from 68 to 41% and then drops again in 2020 from 41 to 33%. So we can see that revenue is growing at a slower rate than it once had been. Assuming that the worst case happens, this company doesn't grow very well going forward because, who knows, they might be facing intense competition and more headwinds, for example, because of the strengthening dollar, because they do sell a lot of goods overseas. So if our New Zealand dollar increases against the US dollars, that would cause the sales in New Zealand dollars to drop. So let's assume that revenue doesn't grow very much, 10% for the first 5 years. And then obviously as the company gets bigger and bigger, revenue growth will slow down. So for years 6 to 10, I have a revenue growth rate here of 5%. So that ends up with a revenue in year 10 of roughly $2.6 billion. For the EBITDA margin, now I use 26%, and that's based on the low rate that the company has guided. Remember that management has targeted a medium-term EBITDA margin of 30%. So what I did was I increased the EBITDA margin to 30% over 5 years. So 1% per year until it hits 30%, and it stays constant at 30%. The difference between EBITDA and net profit is essentially your interest, tax, depreciation, and amortization, which is the EBITDA. So to get from EBITDA to net profit, what I did was I calculated what they've historically done in terms of net profit in relation to EBITDA. So I take essentially the numbers from net profit divided by EBITDA. So if you can look at the historical numbers here, this ratio has been increasing to roughly 70%. And this makes sense to me because the company doesn't really have any debt. They don't have much depreciation and amortization because they don't have a lot of capital assets, right, that don't really depreciate very much. So the only thing that they have is taxes. They have to pay taxes, and the New Zealand company tax rate is 28%. So if we take 28%, then this should be 72%, right? Net profit should be 72% of EBITDA, but obviously there's all the other stuff in there, and that's roughly 2%. But management has also guided that the company will spend more on capital expenditure going forward. So what I assumed was that the net profit to EBITDA will decrease over time as the depreciation increases over time because of higher levels of capital expenditure. So I decrease the 70% down to a targeted 65, and I decrease it 1% every year. So as you can see here, it decreases from 70, 69, 68, 67, 66, and flattens out at 65% for the remainder of the calculation. And what I did then was I got net profit after tax based on this percentage. So then what I did was then calculated earnings per share, which is taking the net profit of $255 million, and this is after tax, by the way, divided by the shares outstanding of 743 million. And you can find this number on the NZX website. Now, because this is based on next year's earnings, we have to discount it today to today's price, right? Because $1 tomorrow is worth less than $1 today. So we discount it by my discount rate of 10%, which I earlier explained why, is because we want a higher rate than what we could get on average from an index fund. So that gives us a discounted rate of 31 cents for year one's earnings. Okay, and we do the same up to year 10. Now, for the terminal value, assuming that we sell the stock at year 10, what I did was I forecasted a terminal multiple of roughly 15 times. So this is essentially what the PE ratio of this company will be when we sell the stock in year 10. And I think a terminal multiple or PE multiple of 15 times earnings is fairly reasonable because this company is only growing at 5% in year 10, as you can see here. But at the same time, this is going to be one of the largest companies on the NZX, right? So large companies usually trade at higher multiples because they are seen as more blue chip stocks and people are willing to pay good money for it. So I'm going to give this a terminal multiple of 15 times for a relatively small growth company, okay? And that gives me a intrinsic value based on the sum of all these discounted cash flows here. Okay, so that's $7.06 based on a bear case. So the worst case that can happen, this is how much I would pay for the stock. And now I repeat the same activity, but for the base case. So this is if, the company performs at the midpoint of what they guided for. So I use the midpoint of revenue of $1.475 billion. I use an EBITDA margin of 27.5%. And the revenue growth that I have forecasted for this base case is higher than the bear case. So bear case, I use 10 and 5. For here, I use 15 and 10. So 15 for the first 5 years and 10 for year 6 to year 10. So again, this is fairly reasonable. 15% is not as high as what it was before, but it's still a fairly conservative base case here. And all the assumptions are the same, and I do the same activity, but the terminal multiple here is 20 times. So when a company has a higher growth rate, then they usually trade at higher PE multiples. So I'm forecasting a higher terminal multiple of 20 times compared to the bear case of 15 times. And you add that all up and you get a number of $12.47 per share. So that's pretty close to what the current company is currently trading for at roughly $11 per share. And yeah, it might potentially turn out this way if the company performs at the midpoint of their guidance. But as always, that does depend on the assumptions that you use. So now, moving on to the bull case. The bull case is assuming that the company achieves the high end of their target. So for revenue, that's $1.55 billion, EBITDA margins 29%. And my revenue growth rate for the first 5 years is 20%. Again, that is if the company does really well, if the company manages to turn around the Daigou channels and, start selling a lot again. Their year 6 to year 10 also flows on, increasing at 12%. And that does give us a much higher revenue at year 2030 of $5.6 billion. And in terms of the terminal multiple, a 25 times earnings multiple for a company that has a growth rate of roughly 12% seems reasonable to me. So when you add that all up, this does give the company an intrinsic value of $19.40. So this $19.40 is actually quite close to where the company was when it was trading at all-time highs. So you can see that, when the company was trading at all-time highs a few months ago, the market was pricing in this bull case scenario. But now that we see it's not necessarily going to happen, the share price has then dropped. So the next thing that I did is I assigned a probability to each of these different cases to see what the value would be overall. Okay, so I have a bear case at 25%, a base case at 65% because I think that's more likely to happen. The company should meet their midpoint, and a 10% probability for a bull case. So I put that as 10% because I don't see this as very likely. The company has issued 2 downgrades in a row, so they have a lot to prove going forward. Okay, for me to have a higher probability on the bull case, I would need to see that the company is doing well and actually executing. But at the moment, they are not very good at forecasting, at least from what we've seen in the past few months. So I'm gonna just put a 10% bull case probability. Now, I take the intrinsic values calculated above and I basically multiply these two together and add them all up, and that gives me an intrinsic value of roughly $11.81, which is very close to the current share price at $11. Now, if I want to buy the stock at a 30% margin of safety, then I would need to get the stock at $8.27 per share. So at the moment, the share price of $11 is close to intrinsic value, but I want to buy the stock at a margin of safety. And so for me to buy the stock, the share price will need to continue to drop another 25%. If you have a lower margin of safety, say you only want a 10% margin of safety, then it's trading fairly reasonably close to that point. Obviously, you can download this spreadsheet and change the numbers as you like. So one day, if I'm feeling more optimistic about the company, I'm seeing conditions improve, then I might reduce my margin of safety to 20%. So it's gonna be in the range of roughly $8 to $9 where I start buying stock in A2 Milk. At the current price, I'm not really too enticed at the moment. Now, what you can do next is you can confirm what you calculate on your intrinsic value by using market multiples. So if I change it back to a margin of safety of 30%, here I have the FY21 midpoint net profit after tax that I basically just took from here. So 284 million roughly, and a 38 cents per share earnings. So I took those two numbers and I calculated the PE based on today's share price. So that's $11. So if you buy it at today's share price and assuming that the company hits the midpoint guidance, then you're buying the stock at a 28.7 PE ratio, forward PE ratio, right? Because that's next year's PE ratio. But if I'm buying this at my margin of safety price at $8.27, what that means is that I'm only paying a 21.6 forward PE. And for me personally, that makes sense. Like, I would be unlikely to pay a 28.7 forward PE for this type of stock, but a forward PE of 21.6 times is something I'm personally more comfortable with paying for a stock like A2 Milk. I have attached a link of the spreadsheet down in the description below. Let me know if you enjoyed that. Be sure to hit like if you did. I can do more of this for other stocks on the NZX. Just let me know if you're interested in that. Hit the like button to get this video out there and share it with all your friends and, you know, Facebook groups. Really appreciate that if you do. So I just want to give credit to Sven Carlin, who made this spreadsheet. He basically had a intrinsic value calculation spreadsheet, but I've made a lot of changes to this to meet my personal needs in forecasting A2 milk. So if you want to check his channel out, check the video out, yeah, be sure to give it a look. Really good content on that channel. So I hope you enjoyed this video, guys. Hope you got a lot of value out of this. Let me know down below as well what you're doing with A2 milk, whether you're buying or selling. Personally, I'm gonna wait till it drops a little bit more, and I do think there is further downside because a lot of analysts will go home on the weekend updating their spreadsheets as well and then releasing new reports on the company. I can bet you that most of them, if not all of them, will reduce their price targets because, you know, assumptions, revenue especially, flow down into net profit. So it'll be really interesting to see. I think there will be a lot of downgrades coming out and we might see the share price drop further on the back of those downgrades. But at the same time, the share price could go up as well if someone else comes in and wants to take over the company maybe, or, you know, someone builds a big stake or starts accumulating shares in A2 milk. So no one knows where the share price will go in the short term. For me personally, I'm happy to wait this one out till it drops to roughly $8-9 before acquiring shares in A2 milk. Hope you enjoyed this video, guys. Until next time, take care.